Hi, good evening all. We are waiting for a few more participants to join in. Maybe in about 2 minutes, we'll start the presentation. Thank you. So hi, good evening, good morning, and good afternoon, everyone. And thank you for being a part of Global Investing Session 2. Today we have Mr. Andrew Holland with us, and it's a very interactive session where Andrew Holland and Bothik both would discuss how Avendus reduces volatility while investing in Indian equities to generate absolute returns. He would also be discussing his views on the markets and many other questions that you all would be having. Just I'm the founder of Augment Capital Advisors. My name is Anand K. and we started the firm in 2010. We have been in operation for over 10 years now. We have clients all across the globe, especially in US, UK, Netherlands, South Africa, Singapore, and of course in India. We currently manage over $50 million of assets and are present in Bangalore, Mumbai, and Hyderabad. Quick brief about Mr. Andrew Holland. He's been a part of Avendus since 2016, before which he was the CEO of Ambit, where he built the largest and the most successful hedge fund. He was also the managing director for Merrill Lynch in India. And before Merrill Lynch, he was a part of NatWest, Barclays, and Credit Suisse. Bothik is the executive director of Avendus, and he was again with Mr. Andrew Holland, and he was a part of Avendus Capital. He's been in asset management and wealth management, and he's an MBA in finance from SP Jain. So if you have any questions or queries, please put forward, and feel free to ask your questions in the questions column, and we will try to answer those questions. I already have a set of questions, and how we would be going is first, Mr. Holland, Bothik and Holland will talk about the structure and also the strategy of that they follow, and I will be interacting in between with them on, especially more on the market views. So over to you, Bothik and Andrew, and all the best.
Thank you so much, Anand, and thank you everyone for taking time out on a Saturday and joining us on this call. And I've been told that all of you all have joined us from across the globe, so a big thank you for that. What we're going to do today is, and I'm sure you all want to hear more of Andrew rather than me speak. So you're going to hear first Andrew speak about the markets, his view on what he thinks is happening globally and in India, especially from an equity market point of view. And then, I'm going to talk about the couple of strategies that we have, which is especially in the long short space. And, this team specializes in the long short business or the hedge fund business in India. And currently, we are the largest player in the hedge fund industry in India with around $600 million of assets split across two strategies. So during the course of the presentation, we will talk about the two strategies that we have. What do we do there? Along with, obviously, Andrew talk about the markets as well. So just before I hand it over to Andrew to give you his view on the markets, let me just give you a quick background of this team. So as you all can see, Andrew is the CEO for this business, the hedge fund business at Avendus. He comes in with a vast experience in the equity markets, which is 40 years plus. This team started managing long shorts in India 15 years back when the team used to be with Merrill Lynch in India. And they started managing the prop capital at Merrill Lynch with around $500 million of assets. So the journey for long short started then at that point of time for the same team. And the most important thing is that since 2006, the team that Andrew has had on the long short side, especially on the fund management, that team has been with him since then. So it's a consistent team. It's a consistent track record, and that's exactly the reason why we are managing a large size of assets at this point of time in India. So that's pretty much from an introduction point of view. After Andrew talks about the markets, I will talk about the two strategies that we have. One is called the absolute return fund, the other is called the enhanced return fund. So we will talk about both these strategies. But just before that, once again, thank you for joining. Andrew, over to you.
Thank you, and reiterate what Bharti said. Thank you for joining us, and it's a real pleasure to be here. So thank you, Anand, for inviting us. So let me talk about markets. I'm not going to go through too much of what we already know, but what our thinking is. So this is all based now on the fact that we don't get a vaccine very quickly, because obviously that would change the whole narrative completely to a more positive one. But work on the basis that vaccine might not come till next year. This is what we're thinking. Well, first of all, the liquidity and fiscal measures that have been put forward globally by central banks and governments is really giving us all those kind of, I would say, rose-tinted glasses in respect of that. Any news is good news. In terms of what we're seeing in markets, and we've had a very, very strong recovery, as you all know, since the kind of big fall in March, and that's predicated on a few things, which has been obviously this liquidity and the government fiscal measures will tide companies and people over for the 3 months that they were seeing as part of the problem until the economy is kind of reopened. So liquidity itself is really kind of boosting the markets, and because of that, we feel that volatility will remain high over the next few months. And because of liquidity, we're taking the good news of reopening and kind of extrapolating and saying we're going to get a V-shaped recovery in the economy. We're not in that camp at the moment in terms of a V-shaped recovery for either globally or for India. You will see, don't get me wrong, you will see a V-shaped recovery in terms of the numbers in the very short term, because you're coming off from such a very, very low base. So maybe I need to kind of change my alphabet from a U to a W. Maybe that's the right way, because you will see that V, the little B in between, in our view. But for people in Europe or the US, you will know that, particularly in the US, that the number of cases rising is quite alarming again. But I don't see that countries will lock down economies completely this time around. I think there'll be certain states, but all that leads to is two things. One is that will it dampen the consumer confidence to go out there and get into shops and malls and so forth and so on and spend money? So will they save more? And secondly, will there be another kind of thought process that job security might not be there again going forward, and again leading to more kind of higher saving rates? So that's why I think that the market is poised at the moment. Obviously, it's taken a more optimistic view, I think, helped by liquidity and the fact that whatever happens everyone feels the Fed will come out with something new and help. So, but by and large, if you look at the mobility figures across the US and Europe, particularly in the last few weeks, after that early spike, it's starting to flatten off again. Now, obviously, certain countries, will be opening up a lot quicker. The UK, for example, has said, our distancing rules are going to move from 2 meters to 1 meter, which means that, the types of, say, a restaurant who would maybe have 30% capacity under the 2 meter rule can now be nearer to 60 to 70%. So that would be good news. But then it all depends on whether there's a pickup in the number of cases, which was likely seen in the US, which again will kind of make people be a little bit more risk averse. So I think that the jury's out a little bit. We're taking a more U-shaped kind of recovery for global markets. So when the pandemic happened, what we said as an investment team, that we would look at 3 things before we felt we were more confident to take a more optimistic view of markets. One was that the number of virus cases would actually slow down, which we can tick and say, yes, that has happened now. 2 was the reopening of economies, which, yes, has happened again, some faster than others. And 3rd was the volatility index, both in the US and India, which went to as high as 80, to kind of come under 20. But that's been hovering around that 30 to 40 level. So the last aspect of the the 3 components we were looking for has yet to happen, which is why we're seeing this increased volatility in markets. So when we look at India, so what we decided to do, before we look at India, what we decided to do as a team is to take our experience from 2008 and 2009, which was to say that, and people seem to forget that it was actually the market only came to its low in 2009 in March of that year. So you had a lot of volatility around that. So rather than take a view that either most optimistically or negatively about the global economy or markets, that we feel it's more of a trading market, because that's what volatility does. And obviously, we feel that anything at any time could prick the kind of the liquidity bubble, which would bring markets down. So we're taking more of a trading view rather than a long-term fundamental view, because to be honest, the fundamentals are still very unpredictable in terms of what corporate earnings and GDP growth will be. So that's globally. Now for India, one of the I suppose disappointments has been that we haven't seen the government in terms of their fiscal spending be as aggressive as other countries, and obviously that's partly because of the deficits that we run. And the hope is, as we reopen the economy, you might see some help towards industries like airlines, hotels, leisure industry, start to percolate out from the government. More recently, I mean, they have been taking advantage of a rise in the oil price, which is still a lot lower than it was, to increase petrol and diesel prices to kind of shore up their revenues over the last kind of, 9-10 weeks. Every day there seems to be a petrol price or diesel hike increase. So they are trying to effectively do that. And what we've seen is obviously, the economy slowed down very quickly with the lockdown. We had one of the strictest lockdowns, I think, globally since March, and obviously that had a big impact. But what we've been seeing more recently is a nice kind of pickup in the rural economy, and we're starting to see spending, particularly on tractors, starting to show some signs of strong revival. And even though forecasts for GDP growth this year range, from the World Bank of -3, and I think S&P came out with a negative forecast of over 4. It is still, compared to a lot of other countries, not a bad result in a relative basis. So so what we're seeing now is increase in spending from the rural economy. We're starting to see electricity demand pick up. We're starting to see utilization levels across industries kind of get back to that 50–60% very quickly. So we do feel that there's a bright spot in terms of that spending starting to come through, and the monsoon so far have been above normal. So again, that augurs well for the rural economy to kind of lead the economic recovery in terms of consumer spending for India going forward. And I think the other interesting point is that whilst we saw a big outflow from foreign investors in March in particular, since then you've seen quite a lot of interest come back in terms of liquidity helping that globally. But we've seen about $19 billion come into India, but really across just a small number of companies. I mean, Reliance, as you've probably been reading, have garnered about 14 billion of that. But we've also seen quite a number of companies like Bharti, Hindustan Unilever, SBI Cards, all raised money, and it's been well received, very well oversubscribed by foreign investors. So we have seen a good pickup in liquidity in terms of it's finding its way into India, particularly for very well managed dominant companies in their space. So that's been a kind of a feature I've seen over the last 1 month, which again I think augurs well for the markets. In terms of valuations, in terms of PE, now PE I'm kind of looking less at because obviously you're really not going to see earnings growth that strong at all. So on a PE basis, we're probably still looking kind of reasonably valued. But if you look at a price to book valuation, then we're probably at a 20% discount to the normal and about 1 standard deviation below that. So I think that gives us comfort that valuation levels are reasonable from a price to book valuation. So that's the other positive as well. So I think by and large, what we're thinking at the moment is that the markets globally have been driven by liquidity. We never know what's going to either prick that bubble or burst it, but something usually does. We think that it's going to be more of a U-shaped recovery than a V-shaped recovery. And for India, it's going to follow that same pattern. Because we haven't done that any fiscal measures, over the last few months, and hopefully that will come once we kind of fully reopen the economy. Then you might see an extra leg for corporates and their corporate profitability, and also therefore the markets. But without that, ours is going to be more of a prolonged U-shaped recovery, because going into this COVID-19 scenario, anyway, the economy was starting to slow. So that was the backdrop before this happened. So we think valuations remain reasonable, but it's going to be a bit of a long haul in terms of markets getting back to the new highs in the very short term. Low liquidity can obviously as always surprises you on the upside, as well as when we see the corrections. So I'm going to kind of stop there in terms of the markets, because I'm sure you've got lots of great questions to ask. Just really want to give you a flavour of what we're thinking.
Thank you, Andrew, for the quick and a concise brief on what your views on the market. I already have about a few questions on my way, and first question is definitely on the liquidity being the driver, not just for India, but for all the markets across the globe. So the question is, isn't that a fundamentally flawed thesis itself? I mean, saying, the markets are going up because of liquidity and not because of fundamentals. So isn't that a flawed thesis in itself?
As I said, I mean, typically liquidity-driven markets just make you wear rose-tinted glasses. And look at and gives you the opportunity to keep markets higher for longer, whilst you get through the kind of problems of the economy. So what the hope is that you get liquidity keeps markets where they are or at the moment, and then as the economies reopen, then you get that kind of V-shaped or U-shaped recovery, which means that you can flash forward or fast forward to 2021. and say, okay, we're going to see the economic recovery then, and that's what you bake in, right? So you could have, the market's kind of, pricing in what's going to happen in 2021 as the market starts to recover, as the economy starts to recover, and what liquidity does, it gives you that opportunity to say, whatever happens, the Fed's going to come back and help us all, right? And that's the confidence level. So then you get that fear of missing out kind of syndrome, as markets move higher. So that's right. A problem I see. Fundamentally, you're right, and the problem with liquidity-driven markets, as I mentioned, is you just don't know what's going to just prick the bubble sometime. It could well be, like Unilever, saying that we're not going to advertise on Facebook and other kind of social media. Could be the kind of catalyst for the FANG stocks. I don't know. But it could be something like this, which you're not seeing at the moment, comes out of the side, which pricks that liquidity bubble, and everyone gets back to reality. Because all of the things that we think of negatively at the moment, even if you look at the mobility numbers for the US and Europe, they have started to kind of flatten out. And if this virus picks up again, and more states kind of do more of a lockdown, then that disruption comes again, and the whole thesis about airlines, hotels, starting to recover goes away, right? And bankruptcy kind of looms large. So that's the more negative side, which if markets fall, all of this will be thrown out as the reasons why markets are falling.
True. I mean, also good. Thanks for that. And on the valuations, I mean, while you mentioned that markets are trading at one standard deviation below the general valuation, there are many companies that are almost back to those levels that they were trading way back in, let's say March or February. So do you? There's also one more question that says that there are only about 20 most profitable firms are garnering 70% of the country's profit, which was at about 14% 30 years back. So there are two questions here. One is the valuation that you see on index itself, and second is valuations of certain stocks which have been highly profitable irrespective of market conditions. So how do you value both, relatively?
So one of the things that we'll talk about is that on the is taking a more barbell approach to the market. We only deal in large cap companies, so I'm not going to talk on small and mid cap in any particular. Right. I can talk generally, but not in any detail. So if you take a barbell approach, so let's go back to 2008, 2009 first of all. What happened when the markets fell? The best performing sectors were IT, FMCG, and pharma. No different this time around. Not telecoms in there this time around because of the digital part of the equation here. So that was up until March 2009. After 2009, what were the best performing sectors afterwards? Were financials, energy, industrials, and consumer discretionary, mainly autos, right? And that's not going to be, I don't think, anything different this time around. So at the moment, the large companies which are doing well, let's just take a Unilever, for example. Obviously they're doing very well in terms of taking market share, and they're going to continue to do that because all the small and medium-sized businesses below them, do not have that balance sheet, to help them through this time, to either expand. So it's really kind of, being in survival mode for these companies in terms of working capital, rather than trying to think how can we take market share. So the large companies across these sectors will continue to do well. I think the only difference I would say this time around, when people say to me, pharma companies, do you think there's more going ahead? I think this time around there probably is, for two reasons. One is that I think the generic companies will get pricing power back, for some period, which they haven't had for many, many years now. I think that's something that's very big and very new for them. The second point is that as and when a vaccine comes, I am absolutely certain some of these Indian pharma companies will be manufacturing those vaccines. So there's a change in how they will operate going forward as well. So it's a double kind of tailwind for them going forward.
Okay, and question about projections. I mean, especially the GDP projections that many of these rating agencies have come out with. For example, Moody's in June came out with a projection of 0.2% growth in 2020 versus when they came in June, they said India will not grow but have a degrowth of 3%, and followed by Goldman Sachs and ICRA and Fitch and S&P. Most of them have come down, come back and said India will not grow but maybe degrow by anywhere between 3 to 5%. And in these, kind of uncertain environment where nobody is able to project the next 12 months very clearly, because all of them, if you read through, they clearly say that it all depends on how India reacts to this pandemic, right? So how do you come out with a projection in these extremely uncertain times? And not just for this year, and not just for 2021 also, because surprisingly, what I find very startling is that Moody's says we'll have a degrowth of 3%, while in 2021 we'll have a growth of 6.9%. I mean, I'm still not able to understand how do you project, especially during these kind of times.
Yeah, no, it's tough for everybody. I mean, you're seeing projections. I think the worst I've seen is Numora at minus 5.2%, which is where they've been for some time, to be fair to them. But what you'll see, and you've seen this, I think, a little bit in the US as well, is that as you've seen a pickup in demand as people spend more money, those forecasts are being brought a little bit in again in terms of the negativity. In terms of those forecasts. So listen, I think that's what I'm trying to say. That looking at valuations and trying to predict the kind of GDP growth is just fraught with failure, right?
Right.
Because if we got a vaccine tomorrow, for example, which was going to be rolled out, then all forecasts would be off the table and we'd be changing the whole narrative. So I think what we have to look at is really which companies are going to not only survive but expand their market share in this environment and come out of it stronger and bigger and better. And I think that's what the market's been doing very well at, not just in India but overseas as well, in terms of identifying those themes and sectors which are going to do well. Some will be more defensive, obviously, but
right.
The growth will continue for many years after. It's a bit like if you take, say, Nestle or a Unilever in India, it's not as though once this story is over and we go back to maybe more normal circumstances, it's not as though the consumers are going to stop buying these goods. And India is a very young population, so it's going to be a multi-decade of growth for them. It's not going to be just a one-off kind of we're spending more money in essential goods. So it's going to continue as being a good growth story. But obviously, when the economy recovers, you're going to look at those beaten down sectors and companies, which will see a very sharper earnings growth going forward than maybe your steady 10, 15%, kind of that you see for an FMCG company going forward.
Right. So I think these were the three main questions. I'll ask more as and when they come in. Can I request Patrick to talk about the funds?
Sure, Anand. We'll move to the funds now.
Right.
So let me start with the absolute return fund. So like I mentioned, we do have two strategies. We have the absolute return fund and the enhanced return strategy. The absolute return strategy is the more conservative strategy that we manage, and it does sit at the lower end of the risk return curve. This is a 100% long short strategy and fundamentally managed. And the target here is to basically, by doing long short in the equity markets in India, the target is to generate an absolute positive return year on year, irrespective of where the markets move. Our targeted return in this portfolio is to generate a return which is in the band of, let's say, 12 to 15%. Actually closer to 15%, but in the last few years it's been closer to that 12 to 15% band because the markets have been pretty tough. If you look at the historical returns, and these returns that I'm talking about are gross, pre-fees, pre-taxes, and we can talk about the taxes and the fees later. But let's just stick to the strategy first. So if you look at the strategy and the returns that we are targeting here, in the past 15 years that the team has been managing this strategy, obviously the returns that you see in front of you are just for the last 3 years, because that's the time since we've been managing at Avendus. But the track record before that exists for the period we were managing the same strategy at Ambit, or even before that on prop at Merrills. So if I look at the entire track record right from 2006 till date, in these 15 years, in the worst year, we've done close to 12.5%, in a single calendar year. And in any particular, in most years, we've done closer to 15% on a gross basis. And some of the years we've also done upwards of 15%. So that's primarily from a return standpoint on this strategy. Now, again, if you look at the track record, even from a risk standpoint, there are a couple of things which are important here: the volatility and the drawdowns. So the volatility for this strategy historically has averaged at around 5 to 6%. Now, if you kind of compare that to the Indian debt mutual funds, you will see a vol number which is closer to that number of closer to 5 to 6%. And if you were to even look at some of the equity mutual funds or equity index in India, the volatility has been closer to 15% in the Indian equity markets. So the important point here is that our volatility of this strategy, despite dealing in equities, is 1/3 of any equity product or 1/3 of the index, and very close to what you find in debt mutual funds. That's the other important point here. The second important point on risk is drawdowns. So from a drawdown perspective, what I'm referring to is negative returns. And as again, you can see in the slide in front of you, the gray line tells you the returns of our strategy, and the line below that, which says Nifty TRI, is nothing but the returns on the Nifty 50, which is a main index in India, and that's only given as a reference point. We are not benchmarking ourselves to the Nifty or anything like that. But just kind of tells you that our returns on a month-on-month basis have been extremely consistent despite having multiple volatile phases in the market. So if you even see an example of 2018, between Feb and March, the markets corrected, let's say around 8%. We did not lose money in any of the months that time. Even if you see a period, for example, like September, October of 2018, that's when you had the IL&FS crisis in India, which created this entire issue around NBFCs. Even at that point of time, we did manage to stay afloat, and we did not end up losing money or losing capital. So these are just a couple of examples of how we've managed to weave our way through some of these volatile periods. But the most important point here is that we do manage to protect capital at most points of time. In the last 7 years, since the time we've been managing public monies on this strategy, which means 84 months. So which is, I'm taking the track record right from the Ambit period, which is June 2013 till date, we've only seen 6 months of negative returns in this strategy, right? And so 6 months compared to the 84 months in the, of running the strategy, it's just less than 10% of the occasions that we've lost money in. And at peak in a single month, we've lost less than 1%. So, that just tells you we manage the strategy very conservatively, and we do manage to protect capital at most points of time. From a positioning standpoint, we believe that this is a very good replacement for someone who is looking at, a strategy which can generate consistent returns, irrespective of what's happening in the markets, and can be a very good fit as part of the conservative allocation or the debt allocation in the client's portfolio. So any monies that one does not need for 12 months, this is a good product to invest in from our point of view, from positioning standpoint. Now, what I'm going to do is I'm going to pause now. I'm going to ask Andrew to come back in and just talk about how do we go about deploying funds in this strategy.
Thank you. Just before I talk about the strategy, very quickly, there's another couple of elements to the risk management. One, Baltic has already talked about which is, the team is DNA is protect capital first, and that's a very important part to running this strategy. We will take big cash calls. If one, we don't understand markets, volatility might be too high, whatever it might be, we will take big cash calls. And over the years, we've been as high as 90% plus cash in a very short period of time, just to protect capital and wait for markets to settle down. And we can do that because we're not relative to any index, so we're not chasing anything. The second point is, and this is something that we've done since our Merrill Lynch days, is always have a minimum hedge of 30% at any given point of time. Now, just to explain that a little bit, if you all gave me 100 rupees today and we were very bullish about markets and we deployed 100 rupees, then we'd have 76 rupees in our long positions, the stocks we want to buy, and we'd have 24 in our short positions or hedges, which would give us some protection when markets fall. So that's how we started off, knowing full well that probably those shorts at some point will get dragged up by the market because we're very bullish. So I'll come back to that point. So once a month, very formally, that we as an investment team, that's the fund managers, 4 fund managers, myself, 4 research analysts get together. We think about what's going to happen globally in terms of GDP growth, if there is any these days, and then translate that into how that will impact, in particular, global interest rates, commodity prices, and currencies. Because ultimately, those 3 elements do have an impact in India. It could be positive or negative for the economy, or it might just be for certain sectors and companies which, are kind of benefited or not. So we do a global overlay, and then we look at India for the next 2 years in terms of GDP growth. What's it going to be? And then identify those sectors on the sectors on the long side, the sectors we want to buy. To identify those sectors which are going to be the beneficiaries, or the drivers of the economy, because those are the sectors we want to buy. And on the hedges or the short side, what we want to do there is look at those sectors and companies which we feel would underperform for whatever reasons, whether it's global reasons or local reasons. Those are sectors we want to underperform. So going back to my scenario, we're all very bullish. So we'd buy 76 rupees of those companies and sectors which we felt was, going to be the drivers of the economy, because that's where obviously investor interest will be the most, and drive share prices higher, and hedge that with sectors and companies which will underperform over that period compared relatively to other sectors and companies. Now, as the market rises, obviously your hedges or your short side will get dragged up as well. So we'll increase we can increase that 30% to 50, 60, whatever we feel is needed to manage the risk. It could be higher beta names. It could be, a very combination of how we manage the risk. But one of the things we've learned over the last, 14, 15 years of doing this strategy is that when markets fall, that 30% or whatever it might be on your short side are the stocks and sectors which fall most quickly, partly because there was no fundamental reason to buy them, so they got dragged up by the market, so they fall a lot quicker than your long side of the portfolio. And again, therefore, you can on a day-to-day basis manage that risk. So that's in a nutshell how we go about it. I think the other 2 parts of the risk management would be that we have very strong stop loss limits at 15%. When the if the market, say if we buy a stock and it goes down by 10% as a team, we then look at what we should do next. It's an informal review, but at 15%, that stock is taken out of the portfolio, no matter who is bullish on the company. And the second point is that in terms of the risk management, again, we're looking at on the long side, a single stock can be up to about 10% of the portfolio. Typically, it's been around 8%. But on the short side, because we're not taking, this is a hedge, it's not saying this stock will go down. necessarily, but what the exposure there is no more than 1.5 to 2% in terms of the short side of it. And the short side is very actively managed because you can get squeezed very quickly in India on those stocks. So that's in a nutshell what we do. The enhanced fund, which about it we'll talk about now, in terms of the long short side of that strategy is no different from the thinking that we do for the absolute return fund. And again, both funds, we only look at the top 200 companies by market capitalization. Back to you,
Andrew. Andrew, I had a couple of questions here. So one, what I understand, it's not a perfectly hedged strategy. So because you said 70-30 and you can actually increase it to 50-60. So it might not be a perfectly hedged strategy. So in that, when it comes to that, so there can be a situation where all your shorts can hit the 15% stop loss limit. Is that a possibility? And if yes, what kind of impact it will have on the returns?
It's a very good question, and let me tell you. So the worst possible scenario, and you only mentioned one side of it, is that if all our long positions go down and all our short positions go up, right? That would be the worst case. Now, has that happened over the 15 years? Absolutely, of course. There'll be those days, when that can happen, right? But as a team, what we say to ourselves is this just a one-off scenario for the day? Could it happen? Is it going to likely to continue? If it starts to continue the day after, then we'll say, okay, we're doing something wrong, and we'll just cut the position down and start all over again, right? But 99 times out of 100, it's just one of those days. But obviously, it does happen. Don't get me wrong. The other example I give you is this, and it's so a few years back we were long the private banks, mainly HDFC Bank, Kotak Bank, and I think one other. And we were short because the private banks were doing very well, taking market share, and they were taking market share from the PSU banks. So we had quite a number of PSU banks as our hedges, right? And Arun Jaitley, in his wisdom, decided one I think it was Thursday night or something, to announce after market that he's going to recapitalize all of the PSU banks.
Absolutely, right? Yes.
So we walked in the next morning, and we knew they were going to be gap up, and we'd have to close our short positions. So we closed them anywhere from, I think the lowest was 15% higher to 40% higher. Okay. On that day, right? Because don't forget, 1.5 to 2% is our usual holding. On the long side, it's more like 7-8%. We lost more money on the long side of the portfolio because the private banks also got hit than we did on the PSU, right?
Absolutely.
By the end of the month, and we wiped all of that out, that day cost us 0.5% of the portfolio.
Okay. That gives me a good understanding.
It can happen, but it's because you're not taking concentrated bets that you're not you're falling for the short side. The short side is where you get squeezed the most very quickly. Right.
There's one more question which says, what would be because it's an AIF and you have to pay the taxes, right? So the return that you have shared, Bautik, is it post-tax, and what would be the, if not, what would be the post-tax return?
Sure, Ahmed. So the returns that we have shared, on this presentation are basically the pre-tax returns and pre-fees. The net returns to a client in India will be basically 50% of the gross returns that you see on the screen here. Because in the category 3 AIF, what happens is that the fund has to pay 42.7% as taxes on behalf of the clients at the fund level, and what the clients get paid is tax paid income, right? And hence 42.7% goes to the government, a balanced small percentage goes to the fund or the fund managers in terms of fees. And that's the reason broadly the returns that you see here, you can just divide that by 2 to get the net of fees and net of tax returns to any client. But having said that, even if you kind of divide the returns by 2 and the net returns that you see here, Despite that, so that return range will be around, let's say, 6.5 to 7.5%. Now that return range by itself is pretty attractive for any investor in India if you're looking at it as a debt replacement, because as you look at the debt market today, right, your liquid funds have come down to YTMs of 3.75%. Arbitrage funds, again, the rollovers are happening at, let's say, 30-35 basis points, which means you're looking at 4.5% pre-tax returns there in arbitrage funds. And even if you take a good AAA debt fund, you're still looking at now YTMs at close to around 6.5%. Now, all these products, and these are just pre-tax numbers. If I knock off taxes from there, because anything that you don't hold for 3 years, you'll end up paying full taxes. So if I knock off taxes from there, you're looking at like a return range anywhere between 2-2.5% on liquid funds to, let's say, as high as 4-4.5% on arbitrage funds or some of the short-term income funds. So compared to a 2.5 to 4.5 range, one can definitely look at like a 200 to 300 basis point additional return in a strategy like this by taking slightly higher risk. So that's the positioning of this fund, from a client's portfolio point of view, from a post-tax basis.
Right. Okay. There was one question. Yeah, I don't see any more questions. We can go to the next slide.
Sure. So moving to the enhanced return strategy. So the enhanced return strategy is nothing but an extension of what we do in the absolute return strategy. So, whatever Andrew just spoke about in the first fund, how do we do it? What do we do? All of that is being used to run this second strategy, which is called the enhanced return strategy. The biggest difference here is that unlike the first one, this is a relative return product. And what a relative return product basically means is that the objective here is to beat a certain index or a certain benchmark, which was not the case in the first strategy. In the first strategy, our target was to generate absolute returns irrespective of what the markets do. But out here, the target is to beat the benchmark, which is the Nifty 50 index in this case. And what we are trying to do out here is that from a long-term standpoint, our objective is to generate an alpha over the Nifty 50 index, which means generate higher returns compared to the Nifty 50 index over a long period of time, let's say 3 years or longer, but with a lower risk. So the idea here is to generate an alpha with a lower beta. A lower beta would typically tend to mean that we are also looking at a lower risk compared to what you generally see in the equity markets or the Nifty 50 index. The way we construct this portfolio is a pretty interesting way of doing it. So we have two parts of the portfolio. We have the 70% and the 30%. Now the 70% portfolio is basically a mix of around 15 to 20 companies. Now these 15 to 20 companies are primarily large cap stocks that we've been tracking on the absolute return strategy for the last 15 years. So it's not a new universe of stocks that we are dealing in. So from that same universe of the top 200, we pick and choose around 15, 20 names. So it becomes a concentrated portfolio. And the idea is to hold these companies, so to buy these companies and hold them from a long-term perspective. Not too different from what you generally would see a managed account portfolio or a PMS portfolio, or maybe a large cap concentrated mutual fund do. That's exactly what we are doing, but with just 70% of the portfolio. With the balance 30%, what we are doing is basically very similar to what we've been doing on the absolute return strategy, which is again do long short, manage it actively, and depending on our view in the markets, we will tend to have a higher percentage of longs versus shorts if we believe markets are looking positive in the short term, trying to enhance returns in that scenario, or we would have a higher mix of shorts versus longs if we believe that the markets could be going down in the short term. And the third thing that we can do is if you're kind of in an uncertain environment, typically in an environment that we're seeing right now where there is tremendous amount of uncertainty, with a complete dichotomy between what the fundamentals are telling you and what the liquidity is telling you, right? So in an environment like this where you don't know which way the markets can swing in the short term, what we do or what we can do in this portfolio is take high cash calls on the 30% or take a high hedge call, which means that instead of running 100% net long exposure, which you would typically see a long only portfolio do, we can bring that exposure down to, let's say, a 70%, 75%, or 80%. So that's the big advantage that we have of the 30%, which we manage very actively. And the overall idea here is to reduce risk when the markets are bad, or to enhance returns when the markets are looking good. So that's the overall objective of the enhanced return strategy. What I'll do is I will ask Andrew to jump in and tell you more about how do we go about managing funds here. And while I will ask my colleague to also put up the portfolio, which will give you a sense of what do we buy here. Thank you.
So on the so on the long side, as you can see, if you look through the kind of holdings, again, it's that kind of barbell approach that we're taking. We've got a good number of stocks which are in the more defensive sectors, FMCG, telecoms, and pharma. And against that, we have those companies which would benefit from the from an economic recovery in terms of financials, capital goods companies, and auto companies for discretionary spending. And if you look at the long short side, again, you can see that we've increased our weightage in Bharti in particular, and added reliance on that. So what we can do here, so this is the more interesting part. So if you looking on the left hand side, you can see that those lists of companies, and what we can do is that if we feel the market's going higher, and let's just say we think it's going to be led by Reliance, which we already have a holding, we can add in our 30% more to that weightage to take advantage in the shorter term of a share price moving higher, right? On the other side of it, let's say we're holding Reliance, on which we are doing there, as you can see, but we feel that that the markets are going to fall, and it could be led by Reliance. So what you could see on the right hand side is Reliance on the short side of that portfolio to protect the portfolio. So in picking these 20 stocks out of the 15 to 20 stocks out of the 200, obviously we're doing a lot of filters in terms of cash flows, price to earnings, price to book, and sustainability of profits over a longer period. So out of 200, you get down to about 40, 50 stocks, and then we do our top-down, bottom-up approach, which I talked to you about, to get to those long-only stocks. But what the 30% gives me is an advantage of being able to still buy and sell those sectors and companies that don't meet my criteria, my strict criteria of the filters. So let me give you an example. For example, Tata Steel, because of its the fact that it doesn't generate any cash flow, will probably never appear in my screen, get through my screener for many, many years. But if we have a vaccine tomorrow, I can assure you that all metal type companies would rise very very quickly, because you would obviously have the hope that the economic recovery would be very, very quick then. But so whilst we can't buy it on the left side of the portfolio because it doesn't meet our strict criteria, we can buy it or go long in it in that 30%. So the 30% gives me that flexibility to, one, add to or protect my existing portfolio, but also buy and sell sectors and companies which will not be in my portfolio for many years. So it's an extra flexibility that I don't think many long-only funds would have that ability to do. That's it.
I had a couple of questions here.
Yeah.
So one is on the performance of the fund itself. I mean, I believe you mentioned it's a low beta fund, but it's not exactly very low beta, right? I mean, it can continue to be, the beta can be as high as 0.5%, sorry, 50% of the market. And that is the first question. Second is, does this strategy underperform when the markets are going up significantly higher due to whatever reasons? I mean,
Sure.
does it underperform during very severe market up move?
Sure. So, so to answer your first question, which is on the beta is in fact higher compared to even that zero point 0.5 number, because as you can see, we are running a concentrated portfolio on the 70% book, which continues to remain long at all points of time. So the only way we can reduce the beta is using the 30% where we do long and short. So the beta of this portfolio will be typically in the range of, let's say, 0.7 to 0.85. So that's the range of the beta. But having said that, what is also important on the risks front is the volatility, which is another measure of risk. And the volatility of this portfolio has been typically lower than the markets. And the second thing is even drawdowns, which is, as you can see in front of the screen, in the last 1 year, when the index has lost close to 19%, this fund is down close to 12%. Right. So what that tells you is that it has substantially managed to protect the downside in a period when the markets have corrected substantially. And typically when you look at any equity mutual fund, you will see most of the funds closer to that number of 19% or maybe higher, because most funds in the last couple of years, especially actively managed funds, have managed or have underperformed the markets in a significant way. Because in the last couple of years, what we have seen is an extremely polarized market, where you've seen 5 to 10 stocks kind of drive the entire flow of the markets in the last in the last couple of years. So that's the biggest difference that you see on the portfolio. The other thing that I also want to highlight on the portfolio is, we can do a couple of interesting things, as Andrew mentioned. So if you just move to the portfolio page, on that page, you will see that, we can not only oversize positions, something that we hold on the portfolio, as Andrew mentioned, like Reliance, which is 3.1. We've added another exposure of 6% because we believe that there was some short-term catalyst, which means we've taken the weightage from 3% to, let's say, 9%. Similarly, if you see, we have Kotak Mahindra Bank in our core portfolio at 3.6%, but we've added another 2.7% because we believe that there was some short-term catalyst there. So those are two examples on increasing weightages to a stock in the short term because we see a catalyst. Similarly, what we can uniquely do out here is that if you see, Maruti is one of the top holdings there at a 5% exposure in the portfolio. But in the short term, what we have done is that we have taken a short position to Maruti at 0.6%, which helps us reduce the exposure on the portfolio to this stock, which is another advantage, right? Like any other long only fund will have that stock and we'll keep owning that position at all points of time. But the advantage here is that instead, we don't need to go and sell the stock. We can just go and short it in futures and reduce the exposure that we need to if we believe that there is any kind of short-term negative catalyst to any company. Like if we believe that the numbers on auto companies are going to be bad for the next couple of months and there is a possibility that the stock can correct 10-15%, we don't need to sell our core holding, but we can just go and short it in the futures market for a month and reduce the exposure there. So those are a couple of interesting things that we can do in this portfolio, which you can generally not find in a typical long only fund.
And do you also have a sector-wise limit to what you do, or how's the construct on the sector-wise allocation?
No, so in this portfolio there is no sector-wide limit. But having said that, it is important that this fund has a benchmark, which is a Nifty 50 index. So if you look at it, almost 3 months back in the Nifty 50 index, financials had a weightage which was close to 36-37%. Now, if a portfolio like ours has a cap on sectoral exposure, then and if you see financials doing well, then you will tend to underperform. And that's exactly the reason why we don't have a sectoral cap in the fund. What we do have is a single stock cap, which is at 10%.
Okay, I get that. Fine. Yeah, I think there are no more questions on this. We can move to the next slide.
Sure. So what I want to cover now is, so this is again not in terms of a new product or a new strategy, But the same strategy that we just spoke about, which is enhanced return strategy, we also have a dollarized version of that available for, and what I believe is a lot of the participants today are not in India and are from outside India. And if you have dollar assets that you would like to invest in India, but not bring in the monies to India through an NRE or an NRO account, then you could opt for this fund, which is called the Avendus Long Short India Equity Fund. What we have done is that we have set up the same enhanced return strategy in Dublin. And this is domiciled in Dublin. It is available as an underlying in dollars, and the minimum ticket size is 150,000 US dollars. We run this strategy exactly the same way as we run the enhanced return strategy in India. So we believe that this is a fantastic way to participate in the Indian growth story, and in a pretty tax efficient way as well. Because what will happen in this fund is that, so let me just move to the portfolio and tell you how the difference works, especially from a taxation point of view. So if you just go to the portfolio, of this fund. So as you can see on the right hand side is a similar long only portfolio as you saw on the enhanced return fund. And the taxation on this part of the portfolio, whether you invest in the India fund or the fund domiciled in Dublin, the taxation remains the same, which is long-term capital gains of 10% or short-term capital gains at 15%, which is now common for any fund domiciled globally or in India for anyone investing in India. But the biggest difference comes in, which is on the long short side. So on the long short side, what you see on the left-hand side of the screen, and that's the 30% mix. On that 30% for the Indian AIF, the fund needs to pay taxes as business income, which means we need to pay 42.7% as taxes on behalf of the clients on the 30% of the portfolio. But when the same fund is domiciled in Dublin, that same 30% portfolio attracts zero tax in India or in Dublin. Obviously, depending on where the investors are investing from, there will be some kind of home country tax that one will need to pay or not pay. But if you look at it from a fund perspective, there is no tax which is getting charged either in India or in Dublin on this portfolio, specifically on the 30%, which is a long short mix. So that we believe is a fairly big difference between the AIF in India versus the fund which is domiciled in Dublin. Like I said, the minimum ticket size is similar for both. In India, it's a 1 crore ticket size, which is as per regulation for any AIF, whereas the fund in Dublin is 150,000 US dollars. Another important thing that I want to highlight is, the fund does, has gone through all the registrations, wherever it needs to across US or in London or Singapore or Dubai for that matter. And how that helps us is that even from a tax point of view, especially for US investors, we can issue K1 statements, which is very important. And we can not only issue K1 statements for the fund domiciled in Dublin, we can also issue K1 statements for the funds which are domiciled in India. If somebody wants to invest in the Indian fund in INR terms, on the AIF. So that's the other advantage from tax front on both these portfolios. So that's more or less what we wanted to cover today, for both the strategies and for the fund domiciled in India or offshore.
On the investments the offshore fund, I know that the USD plays a key role. Not a key role, but an important role. So is there a way in which do you also hedge USD INR, or you just leave it?
No, so that's a very important point, and I'm sure anyone who's investing from outside India and is investing in India, it is a moot point and a very critical aspect to look at, because you've typically seen the Indian currency being fairly volatile historically. And the way we see it is this, that in this fund, we don't hedge the currency, and there is a reason to it. The hedging cost for the Indian, so the INR USD is around 4.5% annually, right? You'll have to pay some years where it can be slightly higher and some years slightly lower, but the average hedging cost of USD INR is around 4.5%. And if I plot that against the depreciation on the rupee over the last, let's say, 15, 20 years, so if one is actually taking a long-term view on India as in investing, then from a long-term point of view, the average depreciation in the INR versus the USD has been around 3.5%. So the average depreciation has actually been lower compared to the hedging cost. But what does tend to happen is that the movement of the INR versus dollar has been pretty lumpy. So for example, if you look at the movement of INR versus dollar from 2013 till about 2017 or 2017 or 2018 first half, the INR was more or less flat. It barely depreciated in a period of, let's say, 4 to 4.5 years. And in 2018 or 2019, in a single year, you saw a 10% drop in the currency. So the point I'm trying to make is that the depreciation of the rupee tends to be lumpy in a few years, and it may not do anything for sustained period after that. But if one looks at a long-term call and does tend to hold it from a long period of time, then I think the average depreciation will be lower compared to the average hedging cost on this portfolio.
I think that's the only question that I have here. There's one more question finally for Andrew. Maybe post that we can close the call if there are no more questions. People generally also want to understand your views on global markets, especially the US markets, Andrew. I mean, if you have any on US markets.
So it's a question I think I kind of ponder on a day-to-day basis, actually, because on one side of me says, the market's being led by a very, very small number of stocks.
Right.
And that always worries me, because you need to have breadth of market at some point, really, because that will tell you've got a strong economy, right? Now, notwithstanding what we've seen over the last few weeks with a bit of catch up from kind of the value or small and mid cap companies, they really haven't done anything very much. It's really anything to do with value for the last 4 to 5 years has not worked for you whatsoever. So if you've been lucky enough to be in Apple or Netflix or whatever it might be, you've done very well. But outside of that, there might be some companies that I don't know about have done well, but generally you wouldn't have performed that well, and which is what most funds are finding, right, in the US.
Right.
So that's my concern, is that if for any reason that bubble bursts in the FANG stocks, then the hefty falls that you could take, where are you going to make that money up? Because the rest of the sectors have really got nothing to shout home about. And that's the problem I see. But liquidity, I can keep saying this year after year, right, about my concerns on this part of the index. But against all parameters, it's higher than it should be, right, in terms of earnings and everything. So, it's just really the fact that where else do you go when your interest rates are so low? You're going to go into the markets, but you've got some companies with and I'm sure you've seen the stats, right? I think what was it the other day? One company or the whole of the Nasdaq was, or 5 companies were more than half of the world's capitalization, something like that. There was some ridiculous figure that came out, which emphasizes how concentrated the amount of money is. So if that bubble bursts at some point, then there's going to be a lot of damage. Which we saw, I think the last time, what was in .com, right? When that happened, there's a lot of damage done, and it took years and years and years to get back.
Right.
I'm not saying that's going to happen. That's my biggest concern, is that there's no room for error. There's no room for error whatsoever in any of these companies.
Okay,
so I'm not saying that that's going to happen. So, but I think there's no earnings growth in the US. We know that. So it's liquidity which would keep continuing to drive markets. But if for any reason there's a more negative outlook for that, and it affects the FANG stocks as well, then markets, to my mind, would kind of react very, very quickly and very negatively downwards.
Great. Yeah, I personally have a lot of questions to ask, but I know it's not the time to ask you a lot of questions. Thank you, Andrew. Thank you, Bartik, for spending a lot of time today on a Saturday evening, and it was wonderful talking to both of you. And I hope, I mean, if there are any more questions, I might try to speak to you and then answer. But really, it was very, very insightful, and I really thank you for taking your time today.
Thank you so
Well,
much,
thank you
Anand,
for
and thank you, everyone.
Thank you, Anand, and thank you everyone for joining us, and thank you for your great questions. Thank you.
Thank you. Bye-bye. Good night.
Bye.